Victoria, we got the S&P 500. It's up modestly. We're still about 1.5% below last week's record high after that wobble we had on Friday. Has anything in terms of the underpinnings of this rally, a steady economy, Fed going to cut rates, the AI excitement, has anything changed, or have there been reasons you see to question those premises?
Yeah, Mike, I don't think there's been a huge change in what we've seen. Now, we have had some of the momentum, that underlying momentum in the market, pull back a little bit. Think of like number of stocks making 20-day highs, that type of information. That has pulled back, so you're getting a little bit less driving the market internally. But all the items that you said, those are still there. Earnings, obviously, we're just kicking off earnings, but earnings are strong. That will probably be a nice tailwind for the market. I mean, earnings are expected to grow, 8-9%, revenues at 6%. And the most important part, and you guys were just talking about it for the other two companies a moment ago, are the margins. Those are looking to be 13%. So I feel like there hasn't been a huge shift. There's not been a rotation to defensives in the market. That's what we'll be watching for as a signal that there's a true change coming.
Yeah, that's been pretty consistent, right? I mean, you have seen most cyclical sectors doing better than the outright defensive sectors. At the same time, we realize that we got some soggy job growth in this economy, at least in recent months, and the consumer seems pretty bifurcated. So in terms of an investment approach, what would you emphasize right now?
Yeah, really, when we're talking to our clients, we were in a meeting yesterday and going through our concept of it's a bull market, but it's a high-risk bull market. So there are these elements that we think we need to be watching. We're seeing some growth concerns. We're seeing the labor market weaken. We're not getting some of the data to really know what's happening. Is inflation moving higher? But yet you have these tailwinds to the market, like earnings that we were talking about, or like the uptrends that you see in tech and in financials that continue to push the market forward. So you want to be invested, but I think you need to be a little bit cautious and just keep an eye on those warning signs to let you know when maybe you move a little bit more defensive.
It's interesting, given the fact that a lot of these concerns have been surfaced, that you're seeing some of the lower quality parts of the market do a lot of the heavy lifting recently, the more volatile, higher beta stocks. So does that suggest to you that, quality is a relative bargain, or should you just kind of play the game that's underway?
Well, we don't want to play the game in the low quality stocks, right? We want those stocks that have good earnings quality, good free cash flow, so that quality is important to us. But you're right, the lower quality names, look at the rebound we saw on Monday. That's what was really driving the market. So I don't want to play in that space. I would rather take a little step back, buy the dips on some of the higher quality names that I think will do well. Like we said, tech is doing well, industrials are doing well, utilities are well. We love the financials, we always have. So there's some parts of the market you can go in and buy some good names at a discount right now, even though valuations are pretty high across the board.
What's your thought on where the bond market trades right now? I mean, 4% 10-year yields, corporate credit spreads, they've leaked a little bit higher, but they're still very, very tight. Therefore, corporate yields also lower. Is that sending us a strong message about disinflation and good balance sheets, or is there some risk in there as well?
I think, Mike, it's one of the reasons the market is kind of ignoring warning signs is because credit spreads are remaining as tight as they are. It's telling them that people aren't really concerned of a credit event coming in to cause a downturn or a recession. So I think you can go in the bond market on the upside. I think you're looking at a 4.20, 4.30. If we close below 4% on the 10-year, then you've got to go probably down to around a 3.70 level. So we'll see how we close out the rest of this week.
And what are your thoughts about how the Fed takes things from here? Obviously, an October rate cut is almost entirely baked in, and most likely another one in December. Is that as far as we go for now?
I think it might be as far as we go unless we get some really significant information coming in. I mean, you look at the dot plots we had, they're expecting lower unemployment, they're expecting lower inflation, higher growth. None of those are things that tell you you should be cutting rates. October meeting, they're kind of getting a little bit of a pass without the data there. They can take it as an insurance cut. And then we'll see what data looks like going into the December meeting. But I would anticipate a pause going into next year as we have a lot of stimulus stimulus coming, monetary and fiscal, in the first few months of next year, especially related to tax refunds. That's the middle income consumer that will reap the benefits there, and they're the ones that are likely to spend. So we could see a pickup early next year, and that could put the Fed on pause.